Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is David Howard. David is an attorney with Hoge, Fenton, Jones & Appel in San Jose, and he's also an inactive CPA. He was formerly a multinational tax partner with Deloitte LLP, an international CPA firm, for over 20 years. At Deloitte, he developed tax strategies for multinational corporations, for Silicon Valley startups, family corporations, corporate executives, and wealthy individuals. And his former clients encouraged him to return to practice and get into the law. So so that's what he's doing now. David has taught extensively, including for the California CPA Society, New York University Tax Institute, San Jose State Masters in Taxation Program, and much more. And he's recently been helping Hoge Fenton clients get in compliance with the information reporting requirements for offshore bank accounts and trusts, which are nicknamed FBAR, and that's what we're going to be talking about today. So David, thank you for joining me as my guest today.
Sure, my pleasure.
Okay. As we get started, folks, I'm going to caution you, as I usually do. We're talking about a highly complicated area of the tax law, and if you think this might apply to you, we definitely recommend that you get together with tax counselors, and you may very well need to get an attorney involved in this one, I think. So anyway, so David, why don't you explain? First of all, let me say too, this is February 7th, 2012. And so this is going to be airing in some time, and so more information is going to be coming out. For example, we're going to be talking about a new voluntary compliance program. Some of the details aren't out yet, but we're going to talk about it the best we can. Okay, David, why don't you give us a little background? How did this whole thing develop so that the IRS has been looking into these foreign bank accounts?
Well, some time ago, the Union Bank of Switzerland bought a big investment advisory firm here in the U.S. Can't remember, was it Payne Weber or one of the big U.S. firms, and so suddenly they had quite a few American citizens as very wealthy people, and they came up with some tax schemes that were completely illegal and completely fraudulent. And for some people, they were setting up some. They'd have these trusts that just came out of thin air that would form companies, say in Bermuda, that would hold assets that would then be managed and directed by Union Bank of Switzerland. And it was a complete fraud on the U.S. tax system, and all the rest of the taxpayers were paying their fair share of taxes. And there was a whistleblower. Somebody tipped off the IRS that UBS was actively doing this. And I think at first the IRS went after Union Bank of Switzerland and filed a big criminal charge against them and requested the disclosure of the information with respect to, it turned out to be about 52 taxpayers, but billions of dollars. It was an amazing amount of money. And then in the course of poking around, the IRS discovered that there were thousands of U.S. Taxpayers who were setting up secret Swiss bank accounts. And I have a client that met with the UBS banker in San Francisco and signed the papers there and set up a secret Swiss bank account, totally not realizing that this was should be disclosed and all the income should be reported. And the IRS pressed forward against Union Bank of Switzerland to disclose all accounts where the balance was over $1 million. And they were up against Swiss law that would not allow the disclosure. And while that fight was going on, the IRS opened a window of opportunity for voluntary disclosure that says if you will disclose before we force Union Bank of Switzerland to disclose, then we'll give you amnesty. We won't prosecute you for a crime, but you're going to have to pay us 20% of the high water mark, the highest balance you had outstanding over the last 8 years from 2002 forward. And that's how it all got started. And then one thing led to another, and there was so much money coming in from that voluntary disclosure program. I think it was something like $3.3 billion. They opened up another voluntary disclosure program that just shut down last year In 2011, they raised what we're looking at about $1 billion more, and now they've just opened up another one. They say that it's an open-ended one. They're not going to shut it down. But for the first round, it was 20% you had to pay. The 2011, it was 25%. Now they're at 27.5%. But they say if they prosecute you for a crime, they want 50% of your balance. So you're still better off paying the 27.5%. But we can talk about that more if you want.
Yeah.
But it's scary stuff.
It is, and I mean, we're talking about it. Really, it's the Criminal Investigation Division of the IRS that enforces this thing, and that you make all these reports to. So criminal folks means that your ears should be going up and red flags. And again, like I said, there's a good chance you may need to get an attorney involved, especially if you have much significant involved here. Right.
Yeah. And I might add that when they not only they're allowed to fine you $10,000 a year for not just disclosing, and take 50 up to this 20%, 27.5%. But they also want you to file those back tax returns, pay your tax plus penalties and interest. So there's a lot of money being paid in.
Right. Okay. Well, let's get into some of the little details on some of these things, and also some of the changes that are happening.
Right.
Because for 2012, we're dealing with 2011 income tax returns, but also the reports that are happening for this year, and we're seeing some changes that are happening that I wanted to highlight here. We do have an earlier interview or two with David where we talk about this, that you can look at financialinsiderweekly.com in case we don't get to cover maybe everything here. So how about there's just this simple little question that we deal with. It's on Schedule B. That's the schedule on the income tax return where you report your interest and your dividends. So they've got these questions on the bottom. So how has that changed for
Wow, if you take a look at the 2011 return, it's really quite different now. It says if you had more than $1,500 of dividend and or interest, or combination of the two, you must fill out this little disclosure form. Or if you transferred money to or from a foreign trust, you have to fill it out. Or if you have any foreign accounts at all, you have to fill it out. And so you X the boxes to explain whether or not you had foreign bank accounts. And they instruct you to file the FBAR, this foreign bank account report, as well as the 3520, which is the foreign trust and foreign gift form. But actually, there are quite a few other forms, and I presume you're going to get us to there, because that's where the real headache has jumped up to us. But the FBAR is the traditional disclosure form, where if you have all your foreign bank accounts add up to more than $10,000 during the year, you have to disclose all those accounts. Otherwise, you don't. Yet, if your dividend and interest income from any source, you have your deposit Bank of America, your interest income is more than $1,500, you have to disclose whether or not you have foreign accounts. Now, if you X the wrong box, you have filed an incorrect return, and they can get you for tax fraud, I guess.
Or at least perjury or something.
Something bad, and so you got to be really careful, and you're kind of opening the door for the investigation. And frankly, I think that in the course of all these voluntary disclosures, the IRS has come to the conclusion there are a lot of people, there are a lot of other banks besides Union Bank of Switzerland that were doing this stuff, and that there are a lot of people in other countries and a lot of stuff going on all around the world. And so there's kind of shock and dismay. And in Congress, where they're trying to find more revenue, they're always going after this international area. They always are assuming that foreigners are getting away with something, or that people that have money abroad are getting away with something. And so they've put a whole another layer of tax laws on us. And I'm sure you're going to ask me about that.
Well, we'll get into some of these details, but
sure.
Just two things. One is, it used to be that you had to have more than $10,000 offshore in order to be required to check this box. Now it's like any. And so if you
just
got
any foreign account.
If you got a $10 bank account, I mean, it seems ridiculous, but anyway.
You don't have to actually file the FBAR, but you have to check the box at the bottom of the Schedule B.
Yeah, it's kind of crazy. The other is, though, that as I understand it, this report for foreign bank accounts, originally what they were looking for was people who were moving drug money.
Right, money laundering.
Yeah.
That was the whole thing. It was all about. So they're looking for money laundering, drug dealers, and of course terrorism. Now, it's gotten to be the terrorists moving money around. Now it's not for the terrorists, for just people that make mistakes and revenue.
I mean, basically, the way that you raise money without increasing tax rates.
Yeah.
It's just if you can start enforcing the tax laws that we already have.
Oh yeah.
And have people have to actually pay tax on the income that they have. So anyway, so I think that's sort of the movement that we've got going here. All right. Well, let's talk about then some of these special forms that need to be filed and what are the things that you need to disclose and so forth. What do these things do?
Oh well, this is kind of funny. They've got some overlaps here now because they got laws on top of laws on top of laws. And by the way, I'm sure you and I both agree that people should not be able to lie, cheat, and steal and hide money in foreign countries and not disclose it and pay their taxes. But the way they're going after it is really quite. Oh my word! It's always you can really trip and fall very easily and inadvertently. And I've had so many clients come through my place that were just totally ignorant to the law. But fortunately, they've been under the radar. They have too small of accounts, and frankly, they're probably in the category of go and sin no more. Just do it right from now on, because it's peanuts, and you don't really want to make too big of a deal out of it, and that may not be the right advice. You need to really talk to somebody that knows this stuff before you start saying, "Oh, I'm just a peanut case." you may actually be a very important case. So, the first form, the FBAR, is the form that's been around for a while, where you have to disclose each of. Now, it's much more specific. You have to give each account and what the balances were by account, by account, by account. And these are financial institution accounts that you'd have. They'd include investment accounts, and they would include savings accounts and things of that nature. Do you want me to go on to the next form, or do you want to talk about that?
Well, maybe we'll just point out a couple of things. So the number of the form is TD 90-22.1. You can find it at the IRS website, which is www.irs.gov, and you look under Forms and Publications. And one of the things that you need to be aware of is that this is totally different separate from your income tax return, and it has a separate due date. So, and there's no extension.
June 30th.
June 30th, this thing has to be filed. The other thing is the IRS came out with some new regulations related to this form late last year. And so one of the things that they point out is you may need to file several of these, because you need to file one for yourself, but also any entity that you have, including what they call disregarded entities. So for example, if you have a single member LLC, that's just, you report that information on your personal income tax return. Another one that applies to many people is the revocable living trust. Okay, so that's disregarded. You just report the information on your own income tax return. These entities are supposed to file a separate report.
Also, if you have signature authority but no ownership of a foreign account, you should have filed, and they have graciously given you can file last year's form this year.
Oh, how nice.
And that one situation where you had signature authority over an account that you now had no ownership interest in. So that if you're a company, you sign documents for your company, it's your company's account. There are some special rules for those kind of people, but also if you're the trustee, if you're the executor of an estate or an administrator.
So we're in Silicon Valley here. We have a lot of people here from offshore.
Oh yeah.
From East Indian families, Chinese families, and so forth.
Yep.
So some of them, there may not be that much. The Russian families, they probably don't have the money overseas anyway. Yeah. But some of these other families, they do.
Yeah.
And so so you may have a person here that's a U.S. resident, and they may have signature authority over their parents' bank account,
right?
As many people do.
Yep.
And they may have no clue that they're subject to this reporting requirement. So, folks, we're letting you know.
Yep.
That this exists.
Yep.
Okay, Dave, why don't you go ahead and move on to the next form?
Well, the 8938 is the big shocker.
This is the new one.
This is the new form.
Why don't we get into more details on that later? But I guess what's important to remember related to this is going to be included with your federal income tax return if you're an individual.
Right, right.
Okay.
And right now they're at the individual level. This law came into being in 2010 in March, and it's the Foreign Account Tax Compliance Act, which if you run it all together, it comes out as Fat Cat.
Okay.
That's what I call it, Fat
Okay.
Cat. And that shows the attitude of Congress. They think foreigners are getting away with something. And you have to, once again, disclose all your foreign bank accounts, the same stuff that's on the FBAR, you disclose here if you have to file the return. But the filing, but you also have to include if you own an interest in a foreign corporation, a foreign partnership, a foreign PFIC, a foreign, most people don't know what a PFIC is, by the way. And by the way, the IRS is taking the position that if you've invested in a mutual fund that's not a U.S. mutual fund, it's a PFIC, which is what is that? It's a personal foreign investment
company. Yes.
Investment company.
Yeah.
So you got to be careful. But there's a threshold on this one, and that is for a married filing jointly, you have to have at the year-end balance of $100,000 in all these accounts, or a high water mark of $150,000. And there are a lot of other exceptions and so forth. So you may not have to file, but if you do file, this form is gosh awful because you have to show all the different income and where it is reported on your tax return. And then you have to make reference, you have to attach an 8621, which is a PFIC ownership form, foreign trust form, foreign partnership form, and foreign corporations form. And it could take more time to do this one form than your whole 1040. And so it could be, if you have substantial foreign assets, this applies to U.S. citizens and foreigners who are U.S. tax residents. If you're a U.S. citizen or a U.S. taxpayer living outside of the United States, the thresholds are higher for having to file.
Yeah,
but man, it's a duplicate. It completely duplicates the FBAR. And of course, the FBAR is due at the end of June, has its set of penalties. If you don't file the 8938, there's a $10,000 penalty up to a $50,000 penalty, and a 40% penalty on the tax you didn't report from income that should have been reported on that form. So it's not a happy form. And to be honest with you, some practitioners might not even realize they need to do it.
Oh, yeah.
Because if you take a look at the bottom of Schedule B, it doesn't say you need to file this 8938.
Well, I can tell you that in the update classes, they're trying to highlight this.
Not everybody's up to date, I have to say. So it's a little scary. Yeah. Keep
okay.
going.
Well, why don't we talk a little bit about the Form 3520, which is the trust form.
Well, the 3520, my gosh, that form has gotten to be so complicated that now in the back, in the instructions, in the Reduction of Paperwork Act, it says they estimate the time it takes to fill out that form. It says they estimate 42 hours to gather the information, about 7 hours to understand the form, and about 5 hours to fill out the form. And the 3520. And this would include if you have set up a foreign trust, you've received a distribution from a foreign trust, you've received a gift from somebody. Your grandmother lives in Ireland and she gives a gift to you of $100,000 or more, that has to be disclosed. If somebody has set up a trust for you abroad and they're making distributions out to you, that needs to be reported. And there's an ancillary form that goes with the 3520, and that's the 3520-A, which, by the way, anybody that has bought real estate in Mexico should know that if you have to form one of these little trusts to hold the title, right, and you pay the bank $5 a year to be the trustee, and you have to have $100 in the account, and you make $3 of interest income, you have to file 3520-A and to report that. And if not, there are some big penalties, which are all really painful. And if you have a foreign trust, if there's a foreign trust, one of your relatives set up a foreign trust, and it's supposed to distribute the income out to you, but they don't make distributions. They forget, they retain them. Well, now you've got a
foreign account.
You have a foreign account where you're deemed to have invested and transferred money into the foreign trust. and big penalties, and you don't even know that you did it, and so that's really not very happy.
Yeah,
not very happy.
Now the due date for the 3520, it does go along. It is filed separately.
Right.
But if you file an extension for your individual income tax return, you also have an extension for the 3520.
Yeah.
Why don't you talk a little bit about Form 5471?
Well, this is a real trap too, and that is if you form a foreign company that is owned by 5 or fewer U.S. taxpayers, you have to disclose your ownership in that foreign company, and the penalties are quite onerous. Again, $10,000 a year for not filing, and if intentionally not filing, it's quite large. And people, sometimes I have a client that went to Taiwan. The Taiwan tax guy said, oh, you got to set up a company in the Caribbean and have your payroll checks deposited to this Caribbean company, and you won't pay any Taiwanese tax. Well, this guy's a U.S. citizen, even though he's from Taiwan originally, and as a result, he didn't file the 5471, which if you took a close look at, you have to disclose your subpart F income, which nobody knows what it is, but it would mean all that payroll would come right back up into his current tax return. So 5471, I've also had companies sell, some people from some other country live here, form a company in their foreign country, former country, and then they want to sell the business, and they've never filed a 5471. And it's really sad. Also, foreigners setting up a company here need to file the counterpart 5472. And many accountants miss all this stuff.
Right, they don't know.
Right.
Now, there's an annual article in the Journal of Taxation, as I recall, where they sort of go through all of these. Yeah. And so, for you folks that are into tax compliance, and I unfortunately haven't been subscribing for a while, but I did have the list. And sort of watch what's going on. But
Mike, you're a rare duck. I mean, you really read and you think and you keep yourself up to date.
Well,
I have to pat you on the back for that. But you're not typical, and a lot of people just cranking out returns miss this stuff, and there can really be some serious penalties.
I mean, if you're a little grunt, if you will, the person that's filling out all these forms in your H&R Block, I mean, they don't have a clue.
Well, yeah, and it's hard for them to know. And I'll tell you, I got some really sad cases where people should have actually had some kind of an idea, but they were misled.
We've got about 5 minutes left, Dave, just to let you know where we are. So let's talk a little bit about the Voluntary Compliance Initiative, and now you've also said that in some cases maybe that's not the best thing for people to do.
In fact, the IRS itself has put in the voluntary compliance program that ended in 2011. They had an opt-out at the end. After you went through the whole process, you could opt out. And here's the problem: if you go into the voluntary program, it's a mechanical penalty, and you have to fill out pages and pages of questionnaires.
They've got all of these forms that they specify on the IRS website that so they're made for you to sort of fill in, yes.
If your CPA were charging you $1 an hour, it'd cost you a lot of money to fill out all those forms. And I don't know if anybody just charges $1 an hour. So these forms are extensive, and they're asking every little thing. And then at the end of the day, under the new program, they want 27.5% of the high water mark. Well, what I have found, I have some cases where they did not go into the voluntary program, but they've got really good stories. And I've been able to bring a tear to the eye of the IRS guy. In other words, the IRS has humans there. They aren't mean, nasty people.
Do you bring a string quartet along?
Well, it helps. It helps. But I'll tell you, I had this agent, a very experienced guy, and I told him, I said, I'm going to tell you a story you are not going to believe. And my client was a Vietnamese boat person that escaped, and fortunately, his father had some assets in a foreign country, and his aunt or somebody put him into a foreign account. And lo and behold, a couple of years ago, this all got transferred out, and he had no idea, nothing. And this investigating officer says, "Sounds pretty typical." And he told me what to do to document the source of the funds so that they would get off of his case. And very helpful, very kind. Very competent agent. And I've got 2 other cases that are going the same way, where a woman was appointed as the executor of her father's estate, briefly had signatory authority, gave away all the assets in 05, and now they want, the high water mark was $2 or $3 million. She has no money. It didn't go to her at all.
Yeah.
And again, they're very understanding, but they scare the wits out of you along the way, because potential criminal sanction, potential confiscation of the money or large portions. So you have to make a judgment call on whether or not you want to go into the voluntary program. Yeah. And some of them are too small a cases too. The IRS, you're going to just plug up their system.
Yeah. So I think related to this, I think what's important is to be forthcoming. In other words,
yes, absolutely.
And to communicate with IRS and so forth. And I've had people that I've been dealing with, and they've been very obstinate. I get these older gentlemen and so forth, and this is none of their damn business, and what have you. And what they don't realize is by being obstinate, that gets to being close to being willful.
Yes.
And like I said, maybe they'll be commiserating with each other playing canasta in federal prison.
Right.
Because, I mean, this really is serious stuff when we talk about criminal penalties.
Right.
So anyway, so folks, that's why we're getting this information to you. Maybe it doesn't apply to you. Maybe it applies to somebody that you know. But this information will be posted, again, at financialinsiderweekly.com. under past episodes, so that you can get access and then get some advice. So David, I want to thank you so much for being my guest and joining me here today and talking about this very important topic. And folks, I hope we've given you something to think about, and we'll see you next time on Financial Insider Weekly.